was about 9 p.m. last night when I received a phone call from a dear old high school friend of mine. And she called me because her father had recently passed away, and she received $300,000 in his investment portfolio. In fact, his investment portfolio was assigned to her, okay, as part of her inheritance from her father. And she said that, she had never traded or invested in her life and et cetera, et cetera. And by the way, this past Monday, she joined the ASK THE WIZ Wealth Institute. And she was in our first ASK THE WIZ Wealth Institute Virtual Trading Room, and which we hold from Mondays and Wednesdays from 9:30 until 11:30 a.m. And she said that she was so excited, but she was a little bit concerned. And I asked her, well, why are you concerned? She said, well, I received a letter last week from the fund manager that was managing my father's portfolio. And she said, Wiz, my portfolio that my dad has now, I've inherited from my father, it was worth $350,000 at my father's death. My father transitioned the week after Thanksgiving of 2017. And she said, Wiz, I got a letter last week saying that the fund manager wanted to calm everybody pertaining to the market's drastic turn to the downside. She said she got another letter the end of last week, got one on Monday, Tuesday of last week, and then got another letter by Friday of last week. Now, keep in mind what happened on Thursday. Okay, the Dow dropped by over 1,000 points, 1,032 points on Thursday. So the fund manager quickly sent out a letter to all of the people's portfolios he was managing, okay, or that the firm was managing, telling everybody to be calm, okay? And yes, the Dow did close up on Friday the 9th, 330 points, all right? But that wasn't enough to erase the amount that it had fallen on Thursday. So then she said the reason she was calling me around 9 o'clock last night was there was a robocall that came to her from the same fund manager saying that they were going to have a conference call with all of the people that they were managing their funds, okay, to explain to them to be calm and that the market would right, quote unquote, right itself. So she said, Wiz, what should I do? So, unbeknownst to me, she said, would you please check your email because I've sent you my portfolio. I said, fine. So while we were on the phone, I pulled up the email and looked at the portfolio. And the portfolio was 100%. I said 100% invested in mutual funds that were tied and indexed to the top three major indicators. Talking about that Dow, the S&P, and that NASDAQ. That's a recipe for disaster. Because as goes those indicators, those three major indexes, so goes the portfolio. So when the market's up, the portfolio is up. When the market's down, the portfolio is down. So you got a 50% chance of making money with that portfolio. I don't like those odds. No. I've got to be in a surefire position, whereas whether or not the market goes up or goes down, I'm getting P.A.I.D. And I informed her she should adopt that same philosophy. And she said that's why she's a member of the ASK THE WIZ Wealth Institute. She joined Monday. And then I asked her, are you ready for the truth? Can you handle the truth? She said, yes, Wiz, that's why I'm calling you. I said, let me tell you something. I want you to go online and I want you to look at your father's portfolio, now your portfolio that you received from inheritance. And I want you to see the value of your father's portfolio when he transitioned. So go to the last week of November of 2017 and look at the value of the portfolio today. Do the math. So she logged into the account and went and took a look, and she said, "Oh my God, Dr. Reaves." She said, "Wiz, I've lost $27,642 from November to February in less than 3 months." I said, "You see why? You don't want your portfolio completely pegged, completely indexed to the U.S. markets. You have to be diversified." Bless your heart, your father didn't know any better, okay? But you do. You've got to respect your father's hard-earned money and diversify quick, fast, in a hurry. So she said, "Well, what should I do now?" I said, "Well, you'd be well advised to learn about trailing stops, to learn about stop losses, where you mitigate your risk as it relates to your exposure. Right now, your exposure and your risk are identical. That's a recipe for disaster. You will lose money." She said, "Well, tell me about trailing stops and stop losses." I said, "Look, we'll be on the phone all night. We have over 220 hours of beginner traders and investors webinars on our website that you can go back and review at your leisure. And Mondays and Wednesdays from 9:30 until 11:30 a.m. when we are in the virtual trader room, you can actually see us utilize these strategies and techniques real wide. So you can learn while you earn. But in the interim period, you would be well advised to take your money out of that particular investment firm's grasp and just park it. Park it in treasuries. Park it in laddered CDs. At least you know your principal will be saved. At least you know that you're not going to lose $20-some-odd thousand in 3 months. You may not make a lot on interest, but your principal will be preserved. And let this market work itself out. The market, as I'm speaking to you today, was in negative territory. Now it's up slightly in positive territory. As I said last Thursday, on the 9th, it was down over 1,000 points just to rise the very next day, the Dow, and closed 300 points to the upside. The market is helter-skelter. You don't want money sloshing around in a helter-skelter market. She said she would do that first thing today. And I received a confirmation text around 11:30 this morning that she had indeed told them to send her a check for her money and the value of the account as of today, not the close of trading today, because that's what they're going to try to do. So she needed to have the fund sent to her today. Now, why do you think that the fund manager was sending out those letters? Made the call yesterday that he wanted to have a conference call with all of the people whose monies he was managing, because he only makes money based upon the average balance of funds that he supposedly has under management at any given time. He commissions off of that. If that amount falls, guess what? The amount of money that he makes or commissions falls. So that call wasn't about, those letters weren't about preserving the investors' money. No. You need to be clear on this. It was about maintaining his balance with regards to the funds that he was managing so that he can maintain the amount of commission that he was receiving. Family members, you must understand and understand that everybody, not somebody, everybody has an angle. Where was this person before the market fell? Why weren't they making calls saying this is on the horizon? We need to adjust your portfolios. No. None of the people that were invested in that or whose investments that advisor is holding, they don't need for him to tell them what has happened after the fact. That's obvious. But they need him to be able to monitor the market, not be lazy and just dump their money in U.S.-based or index mutual funds and just receive monthly commissions. No, go to work. You have a moral, fiduciary, spiritual obligation. If you're going to be managing other people's money, then work for it. And the system should be set up that if you're managing money and you lose money, you pay that money back to the people that you lost. That would weed out a whole bunch of people. Okay? How many of you know that you would get paid for something that you did not do? How many of you would get paid at your job, aka on the plantation, if you did a substandard job, or you performed in a substandard manner? No, they wouldn't continue to pay you. But see, financial advisors, quote unquote, they get paid whether or not your portfolio goes up or goes down. That doesn't make any sense. No CENTS or any SENSE. You don't perform, you don't get paid. And if you're handling my money and you don't perform, you owe me a refund. That's the way, okay, the financial services and the financial advisory business should be set up. But it is not. Now, my doctoral dissertation had a null hypothesis that stated that the majority of wealth during the Gilded Age, slightly after the Gilded Age, was obtained by the uber wealthy during the 1929 stock market crash. I'm talking about the Astors. I'm talking about the Carnegies. I'm talking about the Mellons. I'm talking about the Vanderbilts. And I can go on and on. I'm talking about the Goulds. And I can go on and on. How, pray tell, did they make the majority of their money during the worst depression in U.S. history? You see, a lot of people operate under the auspices of trading and investing, thinking that you could only make money when the market rises. No. You can make money more quickly. You can generate revenue income more quickly when the market falls. Listen.